Very good evening to all of you. On behalf of Auditing and Assurance Standards Board of Institute of Chartered Accountant of India, I welcome you all in today's webinar on expectation gap in audit and responding to the fraud risk. As we all are aware, the topic is very relevant and very important. We are having with us CA Surat Mukherjee ji, very learned, very respected from our Chartered Accountant fraternity. So on behalf of AASB of ICI, I welcome respected CA Surat Mukherjee ji. Namaste, sir. Welcome to you on this AASB platform.
Thank you, Anil ji.
We are also having, thank you, sir. We are also having with us very respected and learned CA KK Jain ji as a moderator of today's webinar. So I welcome you, KK Jain, sir. And thanks for giving your consent to moderate today's webinar. Welcome to you, sir.
Thank you, sir.
I also welcome all the participants of today's webinar. Honorable Chairman, sir, and Honorable Vice Chairman, sir, both are stuck up in another meeting. So I'm taking this liberty to start the webinar. And I request respected CA KK Jain, sir, to please start the proceedings of today's webinar. Over to you, sir, please.
Thank you, sir. Good afternoon, everyone. I wish you a very happy New Year 2025. A very warm welcome to our guest speaker, CA Surat Mukherjee, sir, to all the participants and to the team of AASB of ICI. A special thanks to our guest speaker, CA Surat Mukherjee, sir. It is an honor to be graced by the presence of such an accomplished person. May I introduce CA Surat Mukherjee, sir. He is a qualified CA, CMA, CISA, CFE, and CRICP, currently heading Management Assurance in Times Group. Before this, he used to work as Internal Audit and Investigations Head at ACC Limited. Before joining ACC, he was with Dalmia Bharat Group for 13 years, where he was instrumental in setting up the risk management function and scaling it up to match the expansion of the group. Prior to this, Surajji had spent a decade with Sony India Limited and also a 5-year stint with Philips India. Over the past years, he has held leadership positions in various MNCs and Indian organizations and have been able to contribute sustainable results for them in the field of accounting and finance, risk assurance, and controllership roles. He is a regular contributor and speaker in various industry forums like ICI, IA, ICMA, SOCM, etc., and believe in interactive learning through knowledge sharing. Speaker sir will share his presentation on expectation gap in audit and responding to fraud risk for about 1.5 hours. If you have any questions during the webinar, please share them in chat box. The same will be replied one by one. Over to speaker sir.
Thank you, Jain Saab. Thank you, Anil ji. Let me share my screen. Just let me know whether it is visible.
Yes, sir. Yes, sir. Fine, sir.
Okay. So this session is on expectation gap in audit and responding to fraud risk. Before I start the session, let me have my disclaimers. All the opinions are my personal one. They in no way represent the view of ICI or my organization, past or future, present. Many stories which we may share are in imaginary nature, unless and until it is specified by me. So please excuse me if there is some similarity which is found by the listeners to this event. And objective of the session is to help us introspect as professionals tasked with this onerous duty to fight corruption and bring transparency in our profession. So how I have taken the flow of session is that we will spend some time on frauds. What is frauds and why they are happening? What are the basic reasons for so much noise around frauds which we are hearing, so many news about corporate failures which we are listening to, white collar crimes, what are they, what is the background, why it happens, why it has been so rampant today, Auditors' responsibility on this particular area of fraud detection, prevention, and reporting, both from the external auditor's perspective as well as from the internal auditor's perspective. Expectation gap of stakeholders with respect to auditors' fraud risk identification and fraud risk reporting. What is our role and what the world expects from us, how realistic they are. And last, the need of the hour, which I believe is fraud risk management. We'll have to manage this risk, which day by day is becoming one of the topmost risk which we are facing. And then to sum it up, the key takeaways. So let's start. So what is fraud? So if we see fraud, the Oxford Dictionary meaning is that it's the crime of getting money by deceiving people. And when we look at section 447 of Companies Act, it defines fraud as fraud concerning affairs of a company or any body corporate, including any act of omission, any act of concealment of any numbers or any factors, and also abuse of any position of the actor or of the person who is actually doing that act of fraud, committed by any person or any other person with the connivance in any manner, with what I have highlighted, an intent to deceive, to gain undue advantage from, or to injure the interest of the company or its shareholders, or its creditors, or any other person, whether there is any wrongful gain or wrongful loss. Association of Certified Fraud Examiners says fraud is any activity that relies on deception to achieve gain. Those individuals committing fraud, the perpetrator, they achieve a gain, and the victim, which can either be a business or a government entity or an organization, suffers a loss. So what happens out here? If we sum it up, all the definitions from the Oxford one to the Companies Act one to the Association of Certified Fraud Examiner one, we would see that the fraudster is deceitfully, purposefully fooling somebody else and taking what is rightfully should be given to somebody else, or which is owned by somebody else, in his own lap or in the lap of the beneficiary. So here there is an intentional act of doing something wrong. When we look at the ACFE fraud survey, which is done every alternate year, we see that fraud is on a rise. Out of the surveyed companies, so what ACFE does is they does survey of multiple companies, their chief audit executives, their CEOs, and they have found out that globally there is a loss of almost 3.1 billion with respect to frauds. Out of their survey, they have found out that there are 1921 cases in 138 countries. And the fraud is almost with respect to 5% of the top line or their revenues, which means that to gain back this fraud, you will have to earn that many number of times in the revenue. So if there is a 5% top line loss, which means the loss to the organization is extremely significant. And out of these losses, what we see is that asset misappropriation fraud is the most rampant, but financial statement fraud is the most impactful. So when we look at financial statement fraud, that is the most impactful, and that is what is almost capable of bringing down organizations. Asset misappropriation fraud, petty frauds, damages the organization but doesn't bring the organization down. But when it comes to financial statement frauds, mostly perpetrated by the management or the senior, that really comes heavily on the organization. Whistleblowing remains one of the key aspects of fraud detection. 43% of the frauds are detected by whistleblowing or by tips. And more than half of these tips comes from an insider, which is an employee who knows about what's going wrong in the organization. So this survey gives us a snapshot of where the world is moving. And with every passing year, this is becoming even more important. This is becoming even more an important survey for all of us. Now, when we look at a breakdown of the survey, we see that what are the primary control weakness that leads to fraud. And here we see that if the internal audit department as well as the external audit department doesn't work well, that leads to significant amount of frauds getting undetected. And that shows that what is the importance of audit in the overall scheme of things. That it's a critical indicator which stops fraud from eventually happening. All the other stakeholders or all the other people, you would see they are in diminishing amounts or numbers, right? So external and internal audit, this is why it is extremely important for an organization. A good, robust auditor, whether be it an internal auditor or an external auditor, is extremely important. So if you see, lack of internal control leads to 32% of frauds. Override of existing internal controls by the management, wherein they are bypassing the control, leads to 19% of fraud. Management overview lacking leads to 18% of the fraud. So these are three key things when we dissect the frauds. These are key items which comes into action. The results of anti-fraud control, if you look at it, the presence of anti-fraud control leads to lowering of fraud losses. So if you have targeted anti-fraud controls, the fraud losses are lower. And also it leads to quicker detection of fraud. More than half of the fraud cases acquired because either there are lack of internal controls or there are override of internal controls from the management who are supposed to create the internal controls. So management is the one who is responsible for creating internal control, making sure they are effective, making sure they are working. Now, if they are overriding the control, that leads to majority of the frauds happening. 82% of the organizations, they changed or modified their anti-fraud controls following the fraud. So now if we see what is white collar crime. Now white collar crime is a crime wherein the fraudster violates the norms of the organization or norms of the law or statute and uses his position of economic power, influence to tamper with the systems or process or books of accounts of the organization. So out of all these factors, this factor of organizational opportunity remains the most critical factor. That I am a managing director of an organization, that I am a controlling authority, that I am a vice president, that I am a chief technology officer or a chief financial officer. I have authority. If I misuse the authority, I can hide things. I can force people to ignore the control lapses. This term was coined by Mr. Edwin Sutherland in 1939. So it's not something which is new. It's something which is happening for quite a long time. And this is one of the key causes of corporate failures, where people who are charged with governance are the people who are actually breaking the norms. What are the factors which are leading to rise of white collar crime? The economy is increasingly running on credit and there is increase in personal debt. New information technology means that opportunity for wrongdoing is going up. We can understand today because of technology, the transparency have gone up and the fraudsters are having a field day. They are having access to our data. They are having access to our information through various means and they are using that against us. Government is using a lot of funds to distribute to the public. So you can see free ration, free subsidies, free benefits. So if you create fake entities, fake individuals, and we keep reading that fake Aadhaar cards, fake PAN cards are being used to siphon up money and government is continuously trying to weed them out. But that's a continuous war which is happening. And there is an overarching culture of nobody comes second. Everybody wants to come first, be it a company, be it an individual. Everybody wants to do well. Everybody wants to show great results. Everybody wants to show great performance so that share value goes up, value of enterprises and entities goes up by hook or by crook. That's the issue. Another interesting feature or another interesting concept is that organizations are inherently criminogenic in nature. This was a finding by Mr. Edward Gross, who said that organizations are performance driven. Every organization will have to get their top line and bottom line done because they are accountable to their stakeholders, their shareholders. Their bonuses depend on it. So their goal is to keep the stakeholders happy. So if they need to do dummy sale, if they have to create false customers, if they have to by hook or by crook make sure that corporate goals are achieved, that guidance are met. Because every time guidance is not met, what we find is that the market punishes the company very strongly. So everybody wants to do their best to hide the bad news and keep only pushing good news. They don't give the right guidance. That is one of the great difference which we have found between well-managed company and companies who are not so well-managed. So companies display criminal tendencies due to their reinforcement of obedience to the people in position and power. So if you see the employees, they would know from day one that something wrong is happening. Something is not meeting the eye. Something is not working properly, but they would not speak up. They would not talk. They will not highlight. They will follow the instructions and they will do what they themselves know is wrong. And in the process, they will be a part and parcel of the fraud. So if any individual who is understanding that there is tampering of records happening or quality of the product is getting breached or weights and measures are getting compromised, if they speak up, the company can have a bad name for a small period of time, but the company will finally survive. But if they don't, a day may come when it will explode on the face and the company may suddenly go bankrupt or suddenly get into a tailspin. That is the danger. And what happens when fraud happens? There is one which is called the direct cost of fraud. You can calculate how much money is lost, how much money is wasted. But the indirect cost, the impact on reputation, impact on brand, impact on employee confidence, impact on employee productivity, these are impossible to quantify. So those things are very, very difficult to take back. So imagine any corporate scandal which have happened, the employees have found out that it is extremely difficult even to say to the world that we work for this company. So something which is a matter of great pride becomes a matter of great shame because people may pull you up saying that, oh, you are working in that company and that company was doing so much fraud and you didn't get to know or you didn't highlight. So without being a participant in the fraud, you may be part of the shame. When it comes to management role in supporting fraud, management finds their own way. Sometimes they say that government regulations are very strong, very unjustified, too much cumbersome to do, regulations are unnecessary. Sometimes they say that damage is so spread among the people that it is hardly anything. So if I am, say, for example, packaging 5 gram less in a packaged item. So 5 gram less for one consumer is nothing, peanuts. We sometimes throw away a packet which has maybe 2 grams or 5 grams as a remaining in that packet. But when you multiply that to the huge amount of packaging which is being done, millions and millions of, then the company gains a lot of quantity of grain or whatever it is packaging. And he could then repackage it literally for free. And sometimes the company says that violations are caused by economic necessity. Why? Because we had to protect the stakeholders' value. We need to protect the job security of employee. If we give the bad news to the market, what will happen? Stock prices will fall. Reputation of the company may go down. So these are funny rationalization which are done by businesses. When they are caught, they come up with these unique, what you call unique responses to it. When we talk about behavioral red flags, the survey also says that living beyond means has been one of the greatest behavioral red flag. So as an auditor, when we see that how the employees' lifestyle are, what kind of money they are getting, and what kind of lifestyle they are having, and you can see that, or if they are regularly talking about financial difficulties, or if they are highlighting that they are very close to vendor, very much affiliated to a certain set of vendors. All these are clear indications that easily things may go wrong. So if they are following up for a vendor payment, or in a way defending the vendor at his back, defending about a quality failure, these are all indications that something is wrong. Some sort of a, what you call, tacit understanding is there between the employees and the vendors. Coming to occupational crime versus organizational crime. So out of these frauds, if you find out that occupational crime or occupational frauds are those frauds which are committed by organizations or companies. And occupational crime involves crimes which are done by individuals in their individual capacity. So if a company is doing some play with quantity, quality of goods, or by not doing a disclosure, or by doing a wrong disclosure, or by falsifying books of accounts, these are all organizational crime. And when you have employees taking bribes or kickbacks or passing poor quality items, those are called occupational crime. Now, with respect to fraud reporting obligations, the management has the primary responsibility to establish that adequate internal control systems are available. They are working and they are able to detect fraud or any error which is there in the company's books of accounts or in accounting. And auditors have a reporting obligation relating to fraud or any suspected fraud under the company. So what we have is that the Companies Act, the Companies Auditors Report Order, or SA 240 all talks about the auditor's responsibility to identify and immediately report fraud to those charged with governance. Various sections talks about that the matter has to be identified, it has to be reported to the audit committee, then a proper investigation has to be done, and the report also need to be tabled to the audit committee. And any fraud in excess of 1 crore has to be also reported to the MCA and the central government. Now, these things are mandated, but even then we see that hardly any frauds are reported. Number of reported frauds are very, very less. So is it that frauds are not happening? But when we get to see large frauds happen, it becomes news headlines. And at that point of time, everybody circles back to the auditor to ask the question what the auditor was doing, what were they up to, why they did not find out at the right point of time. So that is where the expectation gap actually sets in between what the auditor is doing and what the public wants the auditor to do, what the stakeholders wants the auditor to do. So if you see, for external auditors, the International Standards of Auditing, ISA 240, talks about auditors' responsibility relating to fraud in audit of financial statements. ISA 240 clearly says that the purpose of ISA 240 is to establish standards and provide guidance on the auditor's responsibility to consider fraud in the audit of financial statements. So when you are auditing financial statements, we'll have to make sure that we have considered the chance of fraud. We have considered that a fraud may go unnoticed or a fraud may have happened. So they will have to see how the standards and guidance should be applied in relation to the risk of material misstatement due to fraud. We'll discuss about what is material misstatement also going forward. And when we say fraud, we also at the same breath say that it is something which is intentional. It is not something which is unintentional. It's not an error. It is not accidental. So that is the difference between a fraud and an error. Something which is erroneous can be found out more easily, but when somebody is planting a fraud, he will take all measures and efforts to see that it is not caught very easily. So here what we need to see that whether there is a fraud or there is an error, and secondly, is the fraud or the error material? Because that will lead us to the disclosure norms. Now here, auditor is concerned only with fraud that causes a material misstatement. Trivial matters, small frauds are not something which the auditor needs to look into. But having said that, sometimes small frauds can also lead to large revelations. So whenever you get a small fraud, you need to actually go back and redo certain testing procedures to see that whether the small fraud is the only one fraud or there are much deeper story attached to it. So you will have to see whether the fraud was material or not. And when we say material, we mean that the information, if material is material, if omitting, misstating, or obscuring it could be reasonably expected to influence the decision of the financial statement user. So if I am a reader of the books of accounts of a company, I am an investor, I am a prospective collaborator, I'll have to make sure that if by reading the financial statement, I'm investing in the company, or I am collaborating with the company, or I'm buying shares of that company, I should not be misled because of that material misstatement. If I would have known that, had I invested, if my decision is changing, that means it is material. And for every organization, we create a matrix of quantitative value, which means how much is material for my company, how much is material for a Tata Steel, and how is not equal to how much is material for a SME organization. So the balance sheet size will determine whether it is material or it is not material. That is what is extremely important. So the balance sheet size, the larger the company, the material threshold will be larger. Having said that, there is another aspect of qualitative aspects which also takes center stage. Am I doing a non-compliance of a statute? Am I deducting tax and not depositing it? Am I collecting provident fund and not depositing it? So in those cases, the materiality threshold would not come into play. Even if the amount is small, that needs to be reported, that needs to be shared with the reader of the financial statement. So the materiality threshold doesn't work for anything which has to do with the statutory or with the reputation or brand of the organization. Now, ISA 240 also talks about identification and assessment of risk of material misstatement due to fraud and responses to the assessed risk of material misstatement due to fraud. Whether the auditor has put the right kind of people, evaluation of the entity selection and application of the accounting policies, incorporation of the elements of unpredictability in audit procedure. Now, what does it mean? It means that are there surprise audits? Are there surprise verification of inventory, assets, debtor confirmations, which are done, which are not known to the organization? So when we get our books audited, the auditor will let us know about a few confirmation which we need to obtain and give. And then they will select some which they will do directly. Some physical verification, some physical visits. So that is extremely important. If the organization is changing any policy or any accounting principle, change of depreciation, change of provisioning norms, what is the impact of that change? If the change would have not happened, how would the balance sheet look like? How would that particular number look like? Is it being changed to hide a consequence? Say, for example, I used to earlier provide anything more than 90 days old. Today, I suddenly say that no, I'll not provide anything more than 90 days old. I'll only provide anything which is more than 180 days old. Suddenly, many debtors which were earlier provided becomes good. So we'll have to be extremely careful with these. Evaluation of audit evidence. The moment a misstatement is identified, small or big, we need to re-evaluate the assessment of risk of material misstatement due to fraud and the resulting impact on the nature, timing, and extent of audit procedure. Even if one error is found out, how do we know that it may be a tail of a big fraud? So you will have to see that is there a collusion among employees? Is there a collusion among employees, management, or any other third party? So you will have to re-evaluate the evidence, confirmation of customers, debtors. All of these needs to be re-seen again. New and fresh samples need to be taken. Document verification needs to be redone to make sure we are not missing anything which could make us accountable at a later date. So even if there is a small fraud which has come up with, the management wants us to recognize as a one-time fraud or a one-off transaction, we will have to make sure that it is genuinely one-off or not. Or it is that we have stumbled upon a big fraud which could be then picked up from that one-off fraud. Communication to management and those charged with governance. ISA 240 also says that if management is suspected of being involved in fraud, the auditor will have to immediately speak to the board and the audit committee. Those are the people who are charged with governance. And also discuss with them how much additional time will be required in this audit. Do they need an expert to come in? Do they need a forensic audit to be done? So that it is sure that extra effort needs to be taken for completion of the audit, for the auditor to be satisfied that the fraud was a one-off thing and not a thematic or a continual thing. Determine if communications to regulatory and enforcement authorities are needed. NAFRA and Companies Act also says that immediately on identification, it has to be communicated to the relevant authorities and also to those charged with governance. And then upon successful completion of the audit, the final outcome needs to be also presented. So auditors will have to be extremely careful that when they are signing off anything as a one-off case, whether they are really satisfied or not, and if they are not satisfied, if they want a better investigation to be done, a deeper dive needs to be done into it, then they will need to ensure that that actually happens. If it doesn't happen, then they need to raise the red flag at the opportunist time, at the appropriate time. Now, when it comes to expectation gap, we see that it could be seen into three verticals. One can be knowledge gap, one can be audit performance gap, and one could be audit evolution gap. So when we talk about knowledge gap, is like one who is doing the audit. Is he competent? Have they deployed the right kind of people to do the audit? Do they have knowledge about the particular industry? Second is performance gap, that when they have done the audit, have they done all the due procedure or not? And third is evolution gap. With new technology, with new age companies, are the auditors really geared up to manage the risk? Make sure what they are concluding is accurate or not. So here what happens, that you see that there is a gap between what the public think auditors do, what auditors actually do, what auditors are supposed to do, and what the stakeholder or the public actually wants to do. So whenever a fraud comes, otherwise people are not really too much bothered. The general public is not too much bothered about what's going in this domain. But moment something comes into the public domain, everybody has an opinion. And this is where the problem starts. So ACCA has done a survey, and there they asked a few pointed questions. And this was a global survey where in the first task, which of the following best reflects your expectation of the auditor's responsibility of fraud? And if you see the first three colors, the color of gray, red, and green talks about I expect the auditors to detect and report fraud that materially affects the financial statement of the company. However, I recognize that it is not always possible because of inherent limitations which are there to audit. So that is the first grade. So these are the people who really understand what audit is and what to expect from them. The second red block says, I expect auditor to always detect and report any fraud that impacts the financial statement. Third says, I expect auditors to always detect and report any fraud. But if you see an overwhelming, if you add these three blocks, it is always over 80%, 90%, 85%. So in all developed economies, 80 to 85% of the people feels that auditor needs to find out what's going on in the organization. Very interesting. Now, the second question is, if audit does a good job, we would not have any company failure. So if audit, so irrespective of the management and any other things, they are saying that the auditor, if they do their job well, the fraud will stop. Now here, if you see, there is a little difference of opinion. So the more developed countries, around 40% to upwards to 50% feels that yes, it is true. And if you see about in Asian countries, that goes up. And there is over reliance on auditors. It is coming to 75%. So you feel that again, there is significant amount of dependence on auditors as the goalkeeper, that they are one who is going to stop fraud from happening. Should audit evolve to prevent company failure, which means that should auditors adapt new technology, should auditors adapt new skill sets, right? How should the auditor approach an audit assignment? Should they change? Should they evolve? Should their knowledge base change? Should the standards change? There also, if you see, the overwhelming majority of the participants are saying yes. So, in the public domain, in the public perception, auditors are the most, you can say, dependable, trusted stakeholder who can stop a company from doing something wrong. Now, the question is, in real life, is that true? In real life, does it happen that way? The question is, are we doing enough to live up to the expectation which the general public or the stakeholder or the reader of the financial statements they have with us? What are our limitations in this? So when we look at the IIA's 3 lines of defense model, you will see that there is a governing body who is approving the who is actually charged with governance, who is approving the strategic direction and the resource allocation of the organization. And then you have the management who is responsible for both the first line and the second line of defense. First line is doing the work and second line is the checker. So the maker checker happens inside the management. Then comes the third line of defense, which is the internal auditor. Internal auditor can be a team of professionals who is internal to the organization, or it can be a consultant who will come and do the audit. But that's an internal audit. And then comes external audit, who is providing the assurances. And external auditor depends quite a lot with the internal auditor's outcome. So they talk to each other. They should talk to each other. The scope of audit, the output, what is generated, they need to talk to each other. So, but here if you see, extreme amount of pressure or extreme amount of expectation is on these two people. So the people who are the doers, who are sitting out here, who are doing, who are strategizing, who are responsible for designing processes, controls, SOPs, implementing them, making sure they are working, making sure they are in good health, giving IFC certifications to the board, giving management, CFO, CEO certifications to the board are relegated in the background, and more focus, more and more effort is put on internal audit. That's quite unique. More and more effort is put on the statutory audit. So, what are the issues? So, if we look at the issues, and we'll discuss each one of these issues in detail, that there is an expectation gap. There is an expectation gap between what the people want and what we are actually mandated to do. Inherent limitations and constant. We'll see this going forward. Audit is not about 100% checking of every single transaction. There's a method of sampling. There is a method of estimation which happens. Hindsight bias. When things go wrong, everybody becomes an expert. When things are going good, share value is going out of the roof, company is doing well, nobody is bothered. Materiality concept and different terminologies that are used in audit. Sometimes these are alien to most of the people who don't understand the profession. Enhancements in accounting standards. These documents needs to be evolving at a much faster rate in the present, because today the business scenario is evolving. Look at the financial product, look at the nature of companies, the way they are changing. The standards can't fall back. Performance gap. Are the talents, are the people doing audit are really equipped to do so? And conflict of interest. And we'll see all of this going forward. So when it comes to fraud detection, the stakeholders feel that yes, it is the responsibility of the auditor to find out what's going wrong, everything that is going wrong. There is this popular misconception that audit is meant to catch fraud. And that is one of the key responsibilities of audit. So auditor, whenever they get to see anything which is little suspicious or anything which can be doubted, they should keep probing into it, spending a lot of time. But in reality, that is extremely difficult because audit is a time-bound exercise and there is a method through which it has to be done. So if the auditor starts investing huge amount of time in probing every single aberration, then it will become a forensic investigation. Every audit will become a forensic investigation, and which is actually not the purpose. And last is the going concern concept, that the company is healthy, the company is going to stay alive for a longer period of time. Nothing will happen to the organization which will suddenly bring it down, which will suddenly make it vanish. Look at what happened with the largest, one of the leading airlines of India, Jet Airways, one of the leading upcoming private sector bank, Yes Bank. They just vanished. ILFS. There are many which we can see, which were respected, reputed, AA, AAA rated commercial paper, debentures, bonds in the market. And overnight, they vanish. How can that happen? Where are things going wrong? So if you see in the actual audit process, people don't understand how sampling is done. Stakeholders really don't understand. The reader of the financial statement, they don't not even understand how sampling is done. What is the concept of materiality? What is the concept of scope of different audit? They understand that there are lots of audit. Statutory audit, internal audit, cost audit, tax audit, ISO audit, GST audit. What are the scope of each of one of them? Where they overlap? What are their desired outcome? How is audit carried out? Is it carried out over a 2 months period, throughout the year, continuously done? How much time they invest in fraud detection in an audit? Is it an absolute assurance or a reasonable assurance? Audit is, we all know, is about a reasonable assurance that controls are working, that the financial statement represents a true and fair view. It's not an absolute assurance. Auditors are not sitting on each and every transaction as and when they happen. Language in audit report, too complicated for the stakeholders to understand. A lot of sections, lot of jargons are there, which may not be easy to understand for the stakeholder. Related party identification and conflict of interest, two most important aspects which bring down corporates. Related party transaction, if they are hidden, if they are not clearly disclosed. or if there is conflict of interest between the management and various vendors and various stakeholders. Management representations. Many times, if an auditor wants to get a provision done, an auditor wants to flag off something, there are management representations which come to the rescue. That management finds this to be right, this money to be collectible, this provision need not be done. And at many times, the auditor, based on the management representation, sometimes takes a step back. Can it cost them in future? Reader of the financial statement is obviously not an expert. In multiple cases, they are not an expert. So they really don't understand what those disclosures and what those big notes to accounts talk about and how to read them, how to read contingencies, contingent liabilities, and whether they need to be fearful about them or not. Going concern. Can auditors accurately predict going concern in today's dynamic environment? Suddenly, we can see in quick commerce, while we see Blinkit, Zepto doing roaring business, we are finding Denso is filing for bankruptcy. Same business model, same area of operation. Many a times, even the funding agencies are also same, but it fails. Limitations of audit to assess all available macro and micro parameters and conclude one way or the other. How can auditor assimilate the knowledge? How can it collate the knowledge to finally give a certificate that this organization is going to withstand the competition, withstand the regulatory environment, and strive and grow in the future? And last but not the least, there is dependency on the management's ability to manage risk. As I said, there are examples of in the same industry, companies doing well and companies going bust, companies vanishing overnight. Auditors' independence. Auditors' independence is a basic aspect of their professional work. We know that these days, the auditors are doing multiple, they are dragged into doing multiple types of assignments. So their mission is to guarantee the truthfulness of the financial information. So the auditor, to maintain their fully independent position, is an extremely important thing in the eyes of the stakeholder. Any circumstances linking an auditor to the company it is auditing can affect their impartiality when working. If they have advised the organization in some capacity which is contradicting to their sign off, that could create a red flag in the minds of the stakeholder. Audit and auditors is a very, very delicate position. And their position as an independent guarantor of financial information comes into question. And this situation can be erroneously perceived by the general public. Maybe they are doing some certification or certain jobs which are allowed by the regulator, but still people may feel that something is amiss, something is wrong. Excessive perceptions of the auditor's scope of work. How is materiality, as I mentioned, how is materiality defined? It is not defined alone by the auditor. It is defined by the management and accepted by the auditor. So this is not something which people understands. Sampling techniques. How are data samples picked up? How are sample vouchers picked up? Sample transactions picked up? Is it going to work in today's world, or people want a 100% assurance around it? People want 100% audit through a continuous monitoring. So it is important to understand that the stakeholders sometimes also think that auditors are the people who are drawing up the books of accounts. They are only finalizing the books of accounts. The word finalization in their mind comes to as somebody who is actually doing entries and actually final kind of making the balance sheet and the profit and loss account, which again is not true. They are only checking. So this concept in the minds of the auditors are, in the minds of the stakeholders are different. So, and the technology used in audit to do sampling, to find out exceptions, to catch trends which contradicts with business results, what the business is demonstrating, continuous key control monitoring results, what exceptions are being thrown, management override of controls, the most important thing, because this is through which the most problem happens. When management are bypassing, self-certifying a bypass of a control, IT control environment, how is the IT designed? Can somebody go and do some correction in the back end? Availability of audit trails. That's why even today, the Companies Act have talked about audit trail. Any change in any transaction, posted transaction, reported transaction, why the change is required. So every software needs to now have a audit trail mechanism so that any regulator, any authority, any auditor should be able to go and check if any change has happened. To identify warning trends of business, any abrupt spike of sales, any vendor favoritism, cash flow management. So is auditor leveraging or using enough technology to have a more hands-on approach to a larger data set as compared to few samples which is being picked up? Is the sample representative or not? So the question which the auditor will have to ask themselves is that how they are able to increase their reach on the overall database. The IIA global standards on internal audit, the standard 9.1 talks about understanding governance, risk management, and control processes. As an auditor, one needs to, and when I'm talking about auditor, here I'm talking about internal auditor, because as I mentioned earlier in my 3 line of defense model, that internal auditor is a big conduit between the company and the external auditor. So for them to develop an effective internal audit strategy and a plan, the chief audit executive must understand the organization's governance, risk management, and control processes. So be it an internal person or be it an external organization, third-party outsourced organization who is coming and doing an audit, they will need to understand the overall risk management landscape. The internal audit plan, the risk-based internal audit plan has to be done with the support of the entire organization. And it has to be documented which area to be audited and why those area has been picked up. Why those area has been picked up as an area in which audit will be done. And communicating the acceptance of risk, where the chief audit executive concludes that management has accepted a level of risk that exceeds the organization's risk-taking abilities or risk appetite or risk tolerance, then the matter must be discussed with the senior management and also with the platforms which are charged with governance, like the audit committee or the board members. They need to be told that we are not in sync with the risk which the organization is taking. So if the auditor is uncomfortable, that needs to be told to the people who are charged with governance. So if we look at it, the dilemma of performance versus expectation. So on one hand, you have the public expectation of audit, and on one other hand, you have the public perceptions of performance of the audit. And so the audit, the public perceives that there are shortfall, which is there. Some of the shortfall can be with respect to certain gaps in standards or certain gaps in the regulation, but or something can be because of performance shortfall. But all of this is not real. Having the complete expectation that auditors will be the only agency which will be finding out that frauds are happening or not, they are getting reported or not, they are getting highlighted or not, is not a realistic expectation. The entire platform, the entire governance platform has to be held accountable. But for that, a better communication is required about the role of auditor and the limitations which it carries along with it. The inherent limitation. Auditor is not a parallel authority which is sitting on each and every transaction, not an authority which is signing off each and every transaction. They are only doing checking based on information which is available to them and using technology to find out exceptions and doing extra work only when there is reasonable doubt, when there is errors or fraud which are either indicated by their test or by a whistleblowing mechanism or by an input which has come to them. Now, the Institute of Internal Auditors Practice Guide says that the internal auditor needs to evaluate the organization structure and process for fraud risk governance. They need to perform an assessment of the organization's fraud risk. They need to evaluate the design and operationalization of the fraud risk management program and provide insight and advice to senior management and the board on opportunities to improve the organization's fraud risk management framework. They need to evaluate the indicators of fraud and decide whether any additional action needs to be taken, whether a fraud investigation should be recommended or not, whether the fraud is a smaller one time, not material, or it is something which is serious, something which needs to be investigated by a specialist, by a professional. The practice guide also asks, I will request people to note 3 important things out here. It says, does the management possess the necessary skill, resources, and inclination to provide an effective fraud risk management? Very important. Is the management serious about handling fraud risk? Is the management serious about talking about fraud? Is the management serious about tackling the fraud risk? Did the management cooperate with the assessment of the organization's fraud risk governance, or there was any resistance? Resistance means that things are not transparent, things are not clear. Management is not open to assessment. That's in itself is a red flag. Are there any significant residual fraud risk that the management is not mitigating, that the management is not reducing to acceptable limits? So here the auditor is required to critique the management, their approach, their involvement in the overall risk management process, fraud risk management process. Now, for an auditor to effectively manage fraud risk, they must first identify the risk using a formal risk assessment. Now, I am coming into an area where the auditor needs to involve in making a fraud risk management program. A fraud risk management program will actually help them to create a certain kind of what you call structure, which will help identify risks of fraud which is staring at the organization and how the organization is investing or geared up to meet the challenge. So for an auditor to effectively manage fraud risk, they must first identify the risk using a formal fraud risk assessment, a process aimed to proactively identifying and addressing an organization's vulnerability to both internal and external fraud. It is more an art than a science. Just give me 1 minute. It is tailored to this specific organization. So this is not a one size fits all kind of a approach. It is not that you will do something once and for all and you can copy paste it to every organization. It has to be tailored to the specific organization. What is a fraud risk? It can be similar in a particular industry, but in the industry with multiple organizations, you will have to see how the nuances of that organization needs to be dovetailed into it. And it's an ongoing and a continuous process. Can't be over exaggerated, because today in the operating scenario, we have every organization which is going through a transformation because of the market challenges. So you'll have to make sure that this FRM process is not once done and then casted in stone and stored, but it has to be reviewed in a regular frequency. The objectives of this risk management is to help management recognize what makes the organization most vulnerable to fraud and drive actions to reduce the risk. To use the fraudster's mindset, to think like a fraudster and to ask, where would I look for an opportunity to commit fraud in this organization? How would I do it? And how would I circumvent the controls? How can I override the controls and also not get detected at the same time? How do I conceal my fraud? How do I conceal my act? And the more I can conceal, the more time I can conceal, the more benefit I can take out of it, more benefit I can make out of it. So the objective of this is to identify the inherent fraud risk in the businesses and actions that company has taken to reduce those risks, if any. What is inherent fraud risk? Inherent fraud risk is the risk which is there in day one of my business starting. So if I am going to do a sale, I have a credit risk. That's my inherent risk, right? And then I put controls on it, and whatever is then left behind is called a residual fraud risk. Now, what kind of controls I put on a credit risk? I can take pre-signed check, I can take a bank guarantee, I can take a letter of credit, and I can take such kind of things which guarantees me from credit default. But even after that, a check may bounce, a guarantee may be inadequate because the credit must have gone beyond the guarantee. Or sometimes we have seen in a fraud, even the bank guarantee is a fraudulent bank guarantee which is given. So it can happen that the residual fraud risk even becomes bigger because the control has failed. So in the fraud risk assessment, we need to cover the overall environment in which the company operates, the control environment of the organization. Which industry, which geography, which operating location, all of that needs to be taken into account. Second is the overall culture of the organization. When we say overall culture of the organization, we mean that how the management carries themselves. Do they walk the talk? Do they punish perpetrators in case they are doing fraud? Are there code of conduct and policies which are available? And those are also followed by the people. It's not that in case a fraud is unearthed by a small fellow, a lower level employee, he's terminated. But if a fraud is identified with a top management, the management then starts baby stepping, not taking any harsh action on them. The company's commitment to support an anti-fraud culture. What we mean by anti-fraud culture? Anti-fraud culture means that we are a no-nonsense organization. We don't believe in doing the hook and crook method for achieving our goals. We follow process, we respect law, we respect compliance. And if any fraud is identified, we take very strict action on the people or the company or the subsidiary, whatever it may be. Fourth is leadership behavior and communication. And it is directly linked to the culture of the organization. This has to talk to each other. How does leaders conduct themselves? Are they open? Are they available for feedback? Do they follow the company's protocols and processes, respect the organization's culture? that is, or doesn't put too much pressure on people for unreasonable performance. Adequacy and quality of anti-fraud controls. Now, as the organization grows big, you will find that there is controls. Are they keeping pace with the growth of the organization? Are the controls adequate? Are the controls of high quality so that they can actually stop frauds from happening, stop people trying to freeze the organization? And sixth is quality of the company's response protocol and action. It means how the company takes care of whistleblowing complaints or integrity line or speak up line complaints. When people complain, whether be in anonymity or through a named complaint, how does the organization respond to it? Are they welcomed? Are they investigated? Are they acted upon? Are they taken seriously? Are they communicated back to the complainant? Is it propagated throughout the organization or not? This is an important aspect which we all need to note. Now, when we do fraud risk assessment, we also are touching about a subject called fraud, which is otherwise a taboo in the organization. So improving communication and awareness about fraud is also extremely important. And you will see when you do this exercise with your company, or a consultant comes in to do this activity, you will find that every leader, every head of department functionality is saying that no, fraud doesn't exist in my department. We are a very loyal group of people. We never do anything beyond our purview. We always follow rules and regulations. While in reality, it is rarely so, or you will find that people actually don't know what's going wrong. So having this open communication about fraud, identifying what activities are risky, what activities put the organization to vulnerability is extremely important. And with respect to them, what are the anti-fraud controls which are available? If they are not available, how to jointly develop a plan to mitigate the fraud risk, and at the same time comply with the regulatory and professional standards which are required by the regulatory authority of that particular geography or that particular domain. That's extremely important. So if we do not understand what or who makes our organization susceptible to fraud, in no way we are able to address those things, and every time they will hit us, we'll be caught napping. What are the elements of a good fraud risk assessment? You need collaboration of the entire ecosystem. People should come together in this activity. There has to be trust that this activity is being done not to fault find or not to scapegoat anybody, but to make sure that the organization stays a going concern. The right sponsor means who is launching this activity. Head of audit committee needs to sponsor, needs to give the opening remarks or the opening email to launch this activity, so that you are able to get the right time from the senior level people across the organization. Independence and objectivity. You can't have a fraud risk management program which is biased. Head of sales is my friend, so I feel he's a good man and he can't do anything wrong. Whereas head of procurement, I don't go along with him or her. Hence, I want to really deep dive into his or her area more. That cannot be the way this needs to be handled. It has to be data-based, independent, and handled objectively. Good working knowledge of the business, which means that the team should have good understanding of how the process works, how the business works, both inside and outside the organization. Then only they will be able to understand what vulnerability the organization is subjected to. Access to people at all levels, only possible when there is a right sponsor. When there is a right sponsor, only these people will give you importance, give the team time. Because every time you get a risk, you will have to go back and you will have to discuss and you will have to find out how important is it. Ability to think the unthinkable, which means that you will have to make sure that you are not sitting on this cannot happen or that cannot happen. You will have to think that, imagine the COVID situation which happened. Nobody thought that something can happen which can bring the world to a standstill, right? Nobody thought. People thought that there'll be a tsunami in Southeast Asia. One country may be impacted, a portion of a country may be impacted because of a earthquake. But COVID happened and the entire world was on a standstill. So ability to think the unthinkable and plan for it is important. A plan to keep it alive and relevant, consideration of high risk fraud regardless of their monetary value. That's extremely important. Developing needs good packaging. You will have to package it correctly so that business understands what you are trying to say. Don't be theoretical. Don't only use the language of risk management. Use language which resonates with the management. Remember that one size doesn't fit all. So you cannot take a template, cut, copy, paste, and try to push it forward as something which is applicable to the organization. You will have to make it in such a manner so that it resonates with the audience. Keep it simple. Don't use too much linguistic jargons or technical jargons into it. Keep it simple so that people who run business is able to relate to it. Assemble the right team. Include individuals with diverse knowledge, skills, and perspective to lead and conduct the assessment. So pick people from sales department, marketing department, admin department, HR department, legal department, CSR department. All departments which faces some risk or the other needs to have representation. And the size of the team will depend totally on the method which we are using, which means that is it a big bang approach? Are we going to do the entire organization together? Or we are going to do each function at a time, each location at a time, each subsidiary at a time? So the team size will totally be decided by the approach which we are taking. And we can obviously take external help of a consultant, help of an expert to guide us in area which is either alien to us or where we don't have internal competency. But the team needs to be having a very, very heterogeneous feeling. People from different structures, different stratum, and different departments need to participate in this. Gathering the necessary information, extremely important step. And the starting point would be nothing but all the known past frauds which have happened on the organization or which have been tried on the organization. Identification of the known past frauds, compilation of all complaints from all sources through whistleblowing mechanism or any anonymous letter which has been written to the chairman or to the audit committee, identification of the inherent fraud risk, which means the starting point of the fraud risk before any control is put, assessment of the likelihood and significance of each risk, how much likelihood that this risk can happen and whether it is high, medium or low, identification of specific anti-fraud controls and any risk to management override. Are the controls completely locked or it can be bypassed at the behest of the management? Remember, if anything which is bypassable obviously cannot be taken as something which is foolproof. Assessment of the overall control environment. How does the management look at control environment? How serious the management is, and also assessment of the organization's culture. Now, these two is extremely important because these two determines the engine of this risk assessment process. Whatever you do, whatever you take as an output, whatever you give back to the system will fall through a hole if the management's culture and control environment is not good. So if the culture and the control environment is not good, that poses the single most important risk in this area. Determine the best techniques to use. Talk to people, interview employees, sit across the table and talk to them openly, give them assurance of anonymity, have focus group discussions and workshops where people can sit, talk, and among each other and get into a list. Do surveys. It can be named surveys or it can be anonymous surveys. Any other anonymous feedback mechanism, because many times people, when they sit with their bosses in the focus group discussion, they may not be comfortable sharing the risk which they see. But when they are told to give anonymous feedback without naming them, they would be able to give you more feedbacks. Obtain the stakeholders' agreement on work which has to be performed, and educate employees openly to promote the process. Tell everybody that we are looking at fraud risk, come and contribute, and this we are going to take forward, and we are going to make sure that the organization is more resilient, more strong, and much more capable in fighting frauds, which can actually at times bring the organization down. The assessment will talk about the likelihood, the impact, the risk trend, and the risk velocity. Likelihood and impact is obviously a subjective process. When you talk about a risk, how much likelihood that it can happen, it can fructify, or how much danger it can bring into the organization. Both of these are subjective. Through a discussion process, you will have to assess it on the basis of the industry trends. You will have to find it. So risks are usually assessed using a scale, which can be either quantitative or qualitative. Quantitative scales should align with the organization's fraud risk appetite, the materiality thresholds, and in order to ensure that the fraud risk assessment is credible, engage the stakeholders upfront in the process of setting up the scale, so that it should not happen that at a later time, while the auditors are saying that 1 crore is a big enough number, and we find that the business is saying that 1 crore is not a big enough number for us. So it is important that we decide the matrix in the beginning, the scale in the beginning, and then follow it to find out the likelihood and impact of each one of those. So if you look at this, this is a template of likelihood example. So your rating will be high to low from 1 to 5. And you can see it is either very frequent, reasonably frequent, occasional, or rare. And you have a definition. How many times per year is very frequent? How many times per year is frequent? How many times a year is reasonably frequent, and so on and so forth. And same on probability of occurrence, whether it is absolutely certain, greater than 90% chance, likely, which is 65 to 90% chance, reasonable probability, which is 35 to 60% chance, or remote, which is less than 10% chance. So on impact and on likelihood, you create the templates. So impact example is very high impact, catastrophic impact, that, huge financial loss to the company, international or long drawn media coverage. So if we look at the events, the large events, they have been covered for a long period of time in the press. If you take the Johnson and Johnson case, for example, covering, even legal cases are even going on till today. So which has a widespread employee moral issue, and significant financial penalties or litigations follow. Then the grade is 4, which is major, and you have a grade of financial loss for the organization. And it could be not global coverage, but national long-term media coverage, widespread employee moral, or people leaving the organization. And incidents must be reported to authorities, and sanctions or punishments can happen. So like this, you can create your own grid, and then you can put it against the scenarios to find out in which grid this likelihood and the impact is falling. Then you have risk trend and risk velocity. Risk trend is that in which direction the movement of the particular risk is happening. Is the risk going up, or risk going down. And risk velocity is the speed in which the particular risk occurs. So will you get time to defend, or you will not get time to defend? When the impact happens, is the impact too quick for you to react, or the impact is giving you enough time to prepare yourself? So risk trend and risk velocity are the other two parameters. So likelihood and impact, and trend and velocity. Now, this framework can be helpful for performing, evaluating, and reporting the results of the fraud risk assessment. And we can use COSO ISO 31000 framework to report it, and it has to be customized for the organization. It has to be clearly customized for the organization. It cannot be a copy-paste job. It will never be accepted if it's a copy-paste job. Now, in the assessment framework, you have environment and culture of the organization, adequacy and quality of the anti-fraud controls, leadership, behaviors and communication, and quality and consistency of complaint and response protocol. Now, if I take the last one first, quality and consistency of complaint and response protocol talks about the whistleblowing mechanism. How comfortable are employees to raise their concern to the management through this whistleblowing platform? What are the quality of those complaints coming? Are they mere workplace related problems, small ones, or real quality ones which are coming? And what are you doing with it? Are you taking it forward, investigating it, putting it to a logical conclusion, communicating it to all the stakeholders, and taking action on people, maybe at whatever level they are? Correct? So this again talks equally with the environment of cult and the culture. If the environment and culture is good, if the environment and culture is open, treating everybody equally, then obviously the quality and consistency of complaint and response protocol will flourish. The assessment framework talks about identify and assess the fraud risk driven by the company's overall operating environment and culture, assess the adequacy and quality of targeted anti-fraud controls across the businesses, identify fraud risk created by leadership behavior and communication, and assess the quality and consistency of the complaints and the response protocol. So this in a way is taking care of the output of this fraud risk assessment, that how these controls are doing, how these controls are functioning, how the management is looking at these controls, and any output which is coming either through this control mechanism or coming through the response protocol is being addressed properly or not. Aggregate the results of the activity into a complete fraud risk assessment and compile a fraud risk assessment portfolio. Identify the items that need additional action within the entire portfolio to enable a holistic prioritization and evaluation of the response option. So when you create a final docket or a final document, it has to bring into fore all the important findings, and they need to be then presented to the management. Identify the inherent macro level environmental and cultural drivers of fraud risk for the organization. Using a fraudster's mindset, brainstorm the fraud risk that each driver creates. Identify the action that the business has taken to specifically reduce fraud risk in each area. Consider likelihood, impact, risk, velocity, and risk trend to assess the level of residual fraud risk that remains in each area. Identify the areas that require additional action. So here what is important is that after this entire Manthan exercise, whatever comes out as a output of this exercise needs to be completely closed from top to bottom. What are the risks which has come out? How they are being mitigated? what action is being taken to specifically identify all the risk and making sure that post mitigation, the residual risk is nominal. If the residual risk is not nominal, what additional action needs to be taken? And as I mentioned earlier, this exercise has to be continuous in nature. This exercise has to be ongoing in nature. So when you understand the environment and cultural risk assessment, you look at the strategy which the organization adopts to succeed in marketplace, the KPI and the KRA, which is the key performance index or the key result area of the company as well as the employee, performance management and incentive programs, whether the company wants the employees to succeed at all cost, irrespective of following unethical behavior, the competitive environment in which the organization operates, the regulatory framework, the technology in which the company operates or the landscape, the technical or the artificial intelligence landscape, the talents inside the organization, the manpower, resources, the state of the economy, the operating complexity of the organization, the market in which it is operating, the various business partners and the stakeholder pressure. Investors' pressure at one point of time can be one of the key reasons for which a company can get off rails and start doing funny things. They may break rules, they may adapt what you call, they may adapt unconventional methods, methods which are not approved by law to achieve their final objective. And when we find all of these, we can color code them. And wherein obviously red is high impact, yellow is medium impact, and green is low impact. And for all these aspects, we can actually color code them to see which is in red domain, which is in yellow domain, and which is in green domain. Identify all occupational frauds that could potentially impact the organization. For each scheme check, could this happen in this auditee company? Why or why not? Think like a fraudster, brainstorm with a group to identify any fraud opportunity that one might be missing. Because the game here is to succeed because you are on top of any kind of fraud which can be thrown at you, any kind of challenge which can be thrown at you. Assess the adequacy and quality of anti-fraud controls for each fraud. Assess the likelihood that the fraud will happen, the impact that such fraud will have on the business if it occurs, including impact beyond financial loss, any loss of brand, any loss of reputation, any loss of employee morale. And the fraud risk trend. Is the fraud becoming riskier for the organization or becoming less risky or staying constant? And the risk velocity. How quickly would it impact the organization? How quickly would the impact of the fraud be felt by the organization? So for each fraud identified, assess the roles or teams in the organization that would be able to perpetrate the fraud, including consideration of management control override. The specific anti-fraud control in place, if operating as designed or not, would actually prevent or detect the fraud or not. Based on the inherent fraud risk and effectiveness of steps taken to reduce the risk, provide an assessment of the residual fraud risk and identify any additional action that is needed in this regard. Identify fraud risk due to leadership behavior. As we said, culture and leadership behavior is very important. The questions to be asked is, are leaders ethical? Do leaders' actions align with their words? Are leaders humble or arrogant? Do leaders follow rules? Are leaders interested in feedback? Do leaders maintain a stable team, trusted team? Do leaders take calculated risk? so on and so forth? Or do the leaders provide or impose unrealistic pressures? So these behaviors can actually decide the difference between an ethical organization and an unethical organization. Assess the quality of the whistleblower complaint and response protocol. Is there a whistleblower hotline system? Do people use them? Are complaints investigated? Is there a well-defined escalation protocol? Are root causes identified? Are the findings being shown back to the complainant? Are actions taken on people at all levels? This all come back. To create the fraud risk portfolio, consolidate all of the medium and high fraud risk into one list. For each risk, identify the key drivers of the fraud risk, identify potential action that can be taken against each of the drivers, and consider options to avoid the risk, transfer the risk, assume the risk, or mitigate the risk. Which means that if you have a residual risk, whether as an organization, am I going to stop doing that activity? Am I going to transfer the risk by way of taking an insurance that can be a fidelity insurance also? Or am I going to assume the risk, which means that, okay, it's a cost of doing business. Even if this risk happens, I'm okay with it. Or am I going to reduce the likelihood by putting more controls or investing more in controls? And the impact the action would have on reducing fraud risk. If an action is low or no impact, it should not be in the list, which means when we are presenting to the management, we should only present high and medium risk. Small risk should be avoided. And the resource needed, for example, to mitigate the risk. Do we need more people for maker checker control, or we need more time to mitigate it, or we need some external help to mitigate it? All of that needs to be considered. Work with key stakeholders to prioritize the action in the fraud risk portfolio. You won't be able to take all actions in one go, whatever we have identified, but we make deliberate choices to accept some of the risk or to defer some of the actions, but important action needs to be taken very, very quickly, or low-hanging fruits needs to be acted upon very quickly. We should not leave it, because every unaddressed risk is an opportunity for a fraudster to strike. Not all stakeholders will want to engage in the detail, so we need to create summary output for them so that they can prioritize the actions, they can prioritize the resource requirement and their commitments in making sure that frauds are not going to derail the organization's overall objectives. So the need of the hour is that the stakeholders recognize that a holistic approach is needed to narrow the expectation gap related to fraud and going concern, and that they all play a vital role in driving a meaningful change. Addressing the knowledge gap provides an opportunity to ensure that auditors' roles and responsibilities relating to both fraud and going concern evolve in a more meaningful way. Professional skepticism and applying professional judgment are among the key factors in addressing any performance gap related to fraud. These skill sets could be enhanced through further training. Key points to note for an auditor: we should never assume a fraud-free environment. As an auditor, never shy away to ask difficult questions. Satisfy yourself with the outcome which you get out of these questions. Having proper enterprise risk management and operational risk management linked to a fraud risk management system helps. Whistleblower mechanism to report fraud and how it is dealt with becomes a critical tool to understand the organization ethics and their seriousness to deal fraud. Tone at the top and culture of compliance. There is nothing which can beat it. Proactive and engaging collaboration among internal and statutory auditor counterpart is an absolute need of the hour. With that, I end it, Mr. Jain. Thanks to ICAI, ASB of ICAI, and all the members and students for this wonderful opportunity.
Thank you, Speaker Sir, for very informative deliberation. Some questions have been received from the audience. Sir, first question is, and I will request you to, sir, to please reply those
Sure.
questions. First question, sir. Liability will be on the partner signing the report or on the firm on all the partners in case of fraud established.
So I think, sir, liability is on every stakeholder. So we have seen recently firms are also getting debarred, partners are also getting penalized, they are suspended. Even internal auditors who are working in the organizations are also getting pulled up. So nobody is safe. Specifically for small firms, it becomes extremely important.
Right. The second one question is, how as an auditor can examine the adequacy and quality of anti-fraud controls?
So, sir, that's why I deliberately took the last segment, because fraud risk management once upon a time was a luxury. Today, I believe that every auditor, when he is picking up an assignment, needs to encourage the client or needs to do from his own self by investing time and resource to be sure that the company is on the right track and is addressing the fraud risk well. That is a need. That time and resource needs to be built in to the audit efforts and fees, because without that we are actually throwing arrow in the dark. We actually don't know what is on the other side, and we are trying to uh, target something which we don't know, and hence we are falling prey to any adverse action, because as I mentioned, we are finally the goalkeeper. Every liability is falling on the auditors.
Right. Next question, sir. Sir, could you give examples of trend and velocity of risks? If the risk is, say, insider trading or asset misappropriation, how could the risk increase or decrease with time or have high oblique low velocity?
Yeah, so see, velocity is the ability of the risk to impact your operation, ability of the risk to bring down and significantly impact the organization. So the quantum and the compliance requirement which is there at the back of those, be it related party, be it insider trading, is significant. So if it is happening, it is always for me, it's a high risk, and the velocity of this kind of risk is very high, because the moment you are caught, you will be subjected to multiple punishments and multiple litigations.
Next question will be next question is repetition of question number third, which has already been discussed, sir. No more questions I received, sir. Sir, I extend my hearty thanks to you, Speaker, sir, for sharing your expertise and insights on expectation gap in audit and responding to fraud risks. It was very informative deliberation covering many areas, sir. What public expects of the auditors and what the auditors are required to do, what are the contributing factors and how to overcome the gap. How should auditors respond to fraud risks? Speaker sir, your presentation was received very well by our audience. May I now request Anil sir to conclude the webinar and vote of thanks. Over to Anil sir.
Thank you, Jen, sir.
Thank you so much, sir. Can you hear me?
Yes, yes, yes.
Thank you so much, sir. It was wonderful deliberation, Suraj sir, and hats off to you. You have covered all the aspects relating to this very critical and very important aspect. And once again, thank you so much from the core of my heart, as well as on behalf of AASB of ICI, for, in spite of having very busy schedule and so many meetings lined up, you have given your kind consent to deliberate for our members. So thank you so much once again for your insight as well as expertise shared with all our members. We have gained a lot through your deliberation, sir. Once again, thank you so much. And I also thank CA KK Jain ji for sparing his valuable time and moderating today's webinar, as well as throughout the complete 2 hours he was here listening the our speaker and coordinating with the speaker. So thank you so much, KK Jain sir, for giving
Thank you,
your
sir.
kind consent as well as moderating the webinar. Thank you so much, sir. Thank you so much, Surat sir, once again.
Thank you,
And I
Anish ji,
also
thank you,
thanks
Jain
all
sir.
the participants for today's webinar. Thank you, sir. Thank you so much. Good evening. Good evening.
Thank you, sir.
Good evening, sir.
Thank
Thank
you,
you.
sir. Thank you. Thank you.
Bye, sir.